Step 5 is where I would like to resume our battle with this question. It fits in there right at the end. If you remember in earlier sessions with you, we looked at the question approach, the marks, how to convert into minutes, preparing the blank CSFP. We did think about the associate, if you remember, the group structure and the investment check most recently, and of course now we come to the consolidation adjustments. Now I'd like you to reread the question, please. As you can see there, quite apart from the group structure information, there are other bits and pieces that we need to be aware of. Pacemaker's policy is to value non-controlling interests at their fair values, and we're told that the non-controlling interest is worth 65 million. Now do be careful. I like to teach on a what-if basis. Here, the examiner, Steve Scott, has given us the value of the non-controlling interest in the subsidiary as being 65 million. Occasionally, he'll say to you, each of the shares is worth $1.20 or something like that, in which case you multiply the number of shares by the $1.20 and thereby come to the figure at which you value the NCI. But occasionally he'll say to you the value of the NCI is this much, 65 million, in which case you gratefully accept it. There's been no impairment to goodwill or the value of the investment in Vardeen. So that's not too bad. I could almost, maybe I'll just put a little cross beside that, otherwise I can take it off. Point number 5, at the date of acquisition, Cyclop owned a recently built property, as we saw in our earlier sessions, that was carried at its construction cost of 62 million, but the fair value is 82 million. So basically that's gone up by 20, also known as a fair value adjustment. And to Steve Scott's great credit, he tries to keep the number crunching to the minimum, and so you divide it by 20 years. And of course that's 1 per annum, as we will see. And then there's something about brand valuation. At the date of acquisition, the directors of Pacemaker valued this Cyclop brand at 25 million with the remaining life of 10 years, as we will see, so you just spread it over 25 years. The brand is not included in Cyclop's current statement of financial position, so you've got to bring it in and depreciate it. The fair value of all other identifiable assets and liabilities are fine. And then finally we have so I need to come back to this, as well as this. This is what we call the PUP, provision for unrealized profit. The inventory of Cyclop, that's me, the subsidiary, at the end of the year includes goods supplied by you, the parent, for 56 million. Pacemaker adds a markup of 40% on cost when selling the goods to Cyclop. There are no intergroup receivables, etc. So what we do, as you well know, you take your 40 over 140 and you multiply by the 56. In due course, I'll show you a bit more detail as to how all that works. All right, let's move on. The consolidation adjustments themselves, I'd like to look at in some detail. Here come the consolidation adjustments. Do have a look at the screen. Now, if you remember, the investment in associate was not recorded, had not been recorded at the time you were given the question. So you need to bring it in. So things not yet done become adjustments. I'm trying to make that image as big as I can. I hope you could read that. The investment in V, the associate, Vardeen, the associate, you bought, if you remember, you bought 30 million of my shares, but you gave me 75 million of your shares. And because each of these shares is worth $1.60, and it hasn't been recorded as yet, it must now be recorded. This is the simplest thing in the world. Debit the investment, credit the share capital, and credit the share premium. And obviously that assumes a tiny bit of knowledge from F4. But don't worry, throughout my course, I'll be explaining to you how F7 works on its own, standing on its own. I will not assume any knowledge from F3, which is basic accounting, or F4, which is obviously your law paper. So I'll try to make my F7 stand on its own. So basically what happens here is the market value, which is $1.60, is what we must multiply the 75 million shares by. So don't forget, if you've taken 30 million of my shares and given me 75 million of your shares, what you multiply the 160 by is not 30 million, but 75 million, because those are your shares that we're trying to value. Please be careful of that. And so if you multiply 75 million of your shares by $1.60, that's 120, of course. That's debited, if you like, to the investment. And the credit goes to share capital, the par value, $1. And the excess, the rest, 60 cents, goes to the share premium. So you never put into the share capital account any share premium. Certainly not for F7. So what we're saying is the par value is limited to $1 in this question's case, and any excess value goes to share premium. So to be careful of the par value point. So we move on to the next adjustment. The available for sale other investments. Now, the investment check that we worked out under the group structure shows 77, and that goes up to 82 by the end of this current year. So obviously the fair value adjustment must be raised by 5. The fair value adjustment must be introduced so that the value is raised from 77 to 82. Similarly, the question says that you have 40, or the subsidiary has 40 as its own investment in some other company outside the group, but that goes down, given these recessionary times, to 37. So would you agree that's a minus of 3? So that's quite an involved little series of adjustments. And as far as point 4 is concerned, no need for any adjustment as yet, as we saw. S's property, as we were looking at a couple of minutes ago, that's point number 5. That's what that is there. That's 5 rather than company name. It's 5. S's property at acquisition. 82 from 62, up by 20. And that affects, that divided by 20, of course, the first 20 affects goodwill since it's at acquisition 2 years ago, but the remaining life is 20 years, so we divide it by 20 years as 1 per annum. And so if you multiply the 1 per annum by the 2 years, you should have post-acquisition of 2, a figure of 2. And of course it cannot affect goodwill because it is post-acquisition. So be very, very clear about it. So we're consolidating, shall we say, at the end of this year. That's the reporting date. But if I look back 2 years, at date of acquisition, we do our goodwill. And so the extra 20 affects the goodwill calculation back there. But the moment you establish your goodwill, since the goodwill has been established since that date, you do some depreciation. But that's post-acquisition and therefore cannot affect goodwill. So you do your goodwill, and if there's any depreciation on the extra value you bring in, the fair value adjustment, because that's post-acquisition, it cannot affect goodwill. So the examiner is very keen to test you out. Are you confused? Do you make everything affect goodwill? Of course not. At date of acquisition, you do goodwill. Anything after that cannot affect goodwill. I mean, cannot affect goodwill. Then comes the brand, as we saw. The brand goes up by 25, Kyklop or whatever it's called. And of course, the 10-year life makes it 2.5 per annum. And for 2 years, of course, it's 5. It can affect goodwill, as we were saying, the 5. But clearly, the 25 does affect goodwill at acquisition. Then comes the PUP, as we were saying, 40 over 140 times 56 is 16. And it's not in the net assets list, but directly in the consolidated reserves. The reason, of course, is who sold. In this case, of course, the parent sold. So it goes directly to the consolidated reserves. And how much is a profit, obviously, is a second concern. And, of course, finally, how much is unsold. Sometimes that could be relevant. So, summary of step 5. There are 3 main adjustments: fair value and depreciation, intercompany transfers or cancellations, and of course PUPs. Standards could also come up, things like development expenditure, financial instruments, etc., as we will do later on the course. And we'll build in our knowledge of these international standards and challenge ourselves to do a consolidation question, trying to carry the weight of this extra burden of standards knowledge. So I'm going to do consolidations first, and later we'll add on knowledge on standards to see whether we can come back to consolidations and see if we can carry a slightly heavier load. Great care must be exercised, as the result affects everything that follows. Please be careful.